Welcome back for video 2 of the total portfolio performance for the second half of 2009. My name is Eric Namer-Roseman, Investment Director for the Sovereign Society. Today we're going to focus on part number 2, the first piece of the pie, deep value and recession-resistant international stocks, which are going to be a 20% combined of your total portfolio. Let's turn the page and get going. Okay. Welcome back to our second series, Total Portfolio Performance for the second half of 2009. This is part 2, ladies and gentlemen, the first piece of the pie, deep value and recession-resistant international stocks, which are 20% of your portfolio. So, I love stocks, a liquid way to invest in great companies, and we've had some great considerable success in this area in the sovereign individual since 1997. Now, examples of some big winners. I'm going to show you something here on the next chart. We've booked some winners, of course, over the last 12 years, to say the least. We've also had our share of dogs, and that's why we always maintain a stop loss in all of our open positions. But, of course, we've done very well. We also have a lot of big open positions which are still in significantly in profit territory, namely the Chicago Mercantile Exchange and a lot of mining stocks. But on the closed positions, what we've done over the last several years, Bema Gold was booked about 3 years ago at a 484% profit. Bonavista Energy Trust, a Canadian energy trust, with a 234% gain. Merrill Lynch, Mercury International Gold Fund, an offshore gold mining fund, we closed out at a 187% gain. Prime West Energy Trust with a 182% gain, another Canadian energy trust. And Merrill Lynch World Mining Trust, we closed out about 2 years ago with a 111% gain. That fund invested in base metals and gold mining companies, and we closed out before that market collapsed. So, it has been a great time over the last 12 years to buy stocks up until recently, and now we have to be a lot more careful. We have to buy the right companies at the right price and hopefully stick to those companies that can maintain margins and pay dividends, and that's why we're really focusing in this environment on defensive companies. Okay? So, I'm only recommending right now that 20% of your portfolio, okay, head into international stocks. Like I've said before, I'm not convinced that we are out of the woods yet for the global earnings cycle. In fact, I think it'll be pretty tough going in probably the next 12 to 18 months at the least. And I do think that at some point stocks might hit or take out their March 9th intermittent lows. Not going to happen this year. The market might be okay this year despite another correction on the way. But I don't think we're going to smash out those lows this year. It would seem that the worst phase of the bear market is over for now, but make no mistake about it, it still is, and therefore you don't want to be overweighted in equities. You have to select your equity battles, so to speak, very carefully. So, right now we're very focused on consumer non-cyclicals. I really like the major food companies and the liquor companies. They're selling at compelling prices and offering some very attractive dividends, especially compared to money markets and to bonds, which are staid. One of my favorite plays in this area remains Diageo, spelled D-I-A-G-E-O. The symbol is D-E-O. Here's the chart as I'm showing you right now. Misery loves company, because if you're really depressed and you're upset, you're going to drink more. Well, this is the world's largest liquor company. They produce, of course, Guinness, which is by far one of my favorite beverages in the world, out of Ireland. Johnny Walker, Smirnoff vodka, Tanqueray gin. It goes on and on and on. Just a fantastic liquor company, super cash flow. It's got a nice yield of about 3%. Very attractive multiple. It's selling its business, and it sells. During recessions, of course, people are going to drink even more, unfortunately. But you know, they are going to drink. So I'm very bullish on this company because I really do think the environment that we're going to see in the next few years will be very difficult, unfortunately, for a lot of individuals, particularly those in the middle class, lower end of the middle class range, and they're probably going to take up to the bottle. So without sounding too facetious, it is a consumption trend, I think, that will probably accelerate despite a reduction in consumer spending and discretionary income. So we're still buying Diageo, and we like the stock very, very much. We've already made 90% on Diageo in TSI since we first recommended it, but it still remains a very good buy today. Another stock I also like, as I showed you earlier, was Nestle. We're very bullish on Nestle, the world's largest food company, and we also like Kraft Foods. Both Nestle and Kraft are down since my first recommendation a little while ago because the markets went down so much. But they are very attractive. Nestle has an attractive yield of about 3.6%. Kraft Foods is about 4.7%. Those are very attractive dividend yields, and we're starting to see finally here these stocks are now going up again. And yesterday, General Mills announced that its earnings guidance was going to look much better for the second half of the year because of declining commodity costs, and of course, grain prices going down lately is also a good thing for these companies as well. So we like that. The margins should pick up, but more importantly, they're great defensive companies in a very defensive environment. And people still have to drink, they're still going to booze it up, and they're still, of course, going to eat. And they're going to eat very attractively priced and inexpensive foods, packaged or otherwise. So, as a reminder on stocks, we always use trailing stops, okay? That's very, very important. Don't buy any stock without a 20% trailing stop. The minute you buy that stock, put that 20% stop loss in there, you're out. That's it. End of story. You don't want to debate it. You don't want to think about it a couple of more times. If it breaches that level, you're out. You buy a stock at $10, it hits 8, you're out, okay? Because one of the keys to making big money in the stock market is not to lose large amounts by sticking stubbornly with shares that may reverse with changing circumstances or get pulled down in a resumption of the bear market. We decided to finally get out of most of our equity positions last October, in the first half of October, and that was a good call. So yeah, we took hits. Sure, our stop losses went off like a pinball machine, but we also booked a lot of profits. I mean, you know, and look what happened after that. You know, the market kept bleeding through the second half of October, bled the first 3 weeks of November, came back a little bit in late November, another big bear market rally, and then it crashed again in January, February, and early March. So I think it makes sense. Use those stop losses. Please use those stop losses, folks. It's very, very important. Tomorrow, I'm going to talk about stocks again, but in the commodity area. I'll be talking about natural resource equities, as well as other very attractive plays in the physical commodities markets and how we play those trends. And since that makes up the biggest slice of our asset allocation pie at 25%, namely because of physical gold, which I think is critical to every portfolio today, regardless of your age, regardless of your risk, because of the growing threat to the dollar, you don't want to miss that one. So that's it for now, and I'll see you tomorrow. That concludes video number 2 on international stocks. Tomorrow we're going to focus on video number 3, total portfolio performance for the second half of 2009, transitions and focuses on our third part of the series, which is the second piece of the pie, deep value commodities and resource equities, which are going to be 25% of your portfolio. More on that and tomorrow on commodities and natural resource stocks. See you then.